Hello, Oracles. Well, today was an ugly day. But why was it an ugly day? Well, this is something we had talked about previously about, we're probably going to be anticipating a second bottom coming. And, it was probably going to be in relation to interest rates going up and inflation. And so after we had gotten Fed Powell speaking the last couple of weeks about, we are looking to do a consistent 25 basis point hike, we saw the markets rallying a little bit. They said, okay, we can trade upon this. We are expecting 25 basis point hikes for the next 6 FOMC meetings, and we're good to go. And now all of a sudden, Jerome Powell is saying we're most likely going to get a 50 basis point hike on May 5th, and probably another 50 basis point hike in June. So, of course, the market is reacting to this. So one thing that I paid attention to last time this happened was when the Fed spoke about this, the market sold off. When the actual date happened and we got the interest rates going up, the market rallied. So chances are we are going to see this again. Now, whether we're going to get the rally on May 5th or whether we're going to get it in June has yet to be seen, but I have a feeling we're going to get the same situation. It's going to be a sell the rumor, buy the news situation. Well, how do you know it's a sell the rumor situation? When you see headlines that read, market sells off over concerns that Fed is going to raise rates 50 basis points. Thoughts about, concerns about, these are words that mean it actually hasn't happened yet. It's just people think it's going to happen. And so the market corrects itself based upon these words. A lot of times it's algorithms that are doing the majority of the trading that's going on out there. So they hear words like this and it immediately triggers sale orders. So what ends up happening is those all go through. And then when we actually get to the date that it changes, hey, guess what? It's going to be where it needs to be at anyway, because the market and the algorithms sell down to what would equivalent to a 50 basis point hike. So what happens, we get to the date of the FOMC meeting, we then get the 50 basis point hike, and the market can then rally afterwards. Now, if we only get a 25 basis point hike, well then it's going to rally and correct itself to only a 25 basis point hike. Chances are we're not going to get that. Most likely we are going to get the 50 basis point hike that has been spoken about, but that's why the market just sold off the way it did today. And so what ends up happening is you get a domino effect. The news immediately comes out. Usually it's going to hit like Bloomberg first. Most retail traders do not have access to the Bloomberg terminal, but all the big money does. So the news comes out there, and all of a sudden the algorithms sell off. And then retailers are out here wondering, ooh, what is going on? Why is everything selling off? Then they see the headline, which is delayed. Then they start to sell off. Then prices start to come down, and anybody who is still on margin starts to get triggered. So then all of a sudden sell orders start to get triggered as it falls, just causing a further domino effect of a sell-off. Again, this is nothing to be super concerned about. This is what we had anticipated. It's normal fluctuations in the market. It's not like the market is crashing. It's just something to pay attention to because that is usually how the domino effect in trading goes. So for those of us who are going to be investing long term, this is why we dollar cost average, because we're going to be getting moments like this. And it's moments like this where I start to add more a little bit heavier because I see that this is what's going on. I see that the market is just adjusting to the news of a 50 basis point hike that is potentially going to be happening on May 5th. Now this is only really realistically 2 weeks away. So in 2 weeks, we've also got earnings going on over the next 2 weeks. So as we said, similar to what we saw in Q4 earnings, we may see some sideways trading. Now that the 50 basis point hike is semi-priced in, we might see some little bits of green here and there over the next 2 weeks as we lead up to the meeting. But then we might probably see a little bit more selling off going into the meeting, waiting for it to actually happen. Then when we have the meeting, we might see a little bit of a rally. But as I said, we also have probably another 50 basis point hike coming in June. So if we do get a little rally, it'll probably be short-lived because then we get the CPI data coming out in May for April, And that will let us know, how is inflation looking? Are we actually inflecting down? If we are, this could be a good sign and we might get a little rally out of it. If we are not and we go up, that could be a bad sign and that could cause a further sell-off. Then that's going to reiterate that the Fed is definitely going to need to raise rates 50 basis points in June, and then the market will adjust at that point. So when you're watching things like this, pay attention to what the headlines say, because yes, a lot of times the headlines, don't always tell the full story, but a lot of times the market movements are going to be priced off of these headlines because they look at 50 basis points going up, we're going to sell off to that point. And now, of course, headlines can definitely be manipulated. I look at a lot of times in the morning, I will see headlines that say stocks down on, pre-market due to Fed meeting coming up. And then all of a sudden, pre-market, the market turns and goes green. And then I'll see that exact same headline from the exact same article change to market's green and going positive on the same exact news. It's ridiculous, but they will change the headline to cater to whatever is happening in the market. So, this is why you can't always go by headlines. I mean, many of us as content creators here on YouTube know that algorithms are important as well. Same holds true for mainstream media. If they want their articles to be read, they have to make sure that their headlines are something that is going to catch the attention of the people who are watching it and the algorithms in the search bars in order for people to find it. So many a time you'll see, a content creator, and I don't do it as much myself because I don't have the time, but a lot more of the dedicated content creators that have more time will, you'll see their titles will change. And they change because they need to make sure they're catching the algorithm correctly to be able to have more people view it across the world. Same thing happens in the mainstream media. So this is why you'll see headlines change, and they will cater their headlines to whatever they need to in order to get the viewership that they want. And in the process of doing this, they will then see you'll have people who will see what's going on and they're going to sell off accordingly. But this is why it's so important when you're reading a headline, if you don't grasp the actual concept of what is going on, make sure you read the articles. When you see the concerns about, Fed raising rates 50 basis point, making the market sell off, that's pretty straightforward. We know the market sold off because Jerome Powell said they're most likely going to be raising rates 50 basis points come the next FOMC meeting. That's pretty straightforward. I didn't need to read the article. I knew exactly why the market sold off because of that news. So be it. Now, you might be able to, in some situations, dive into that article, and it could be something like Jerome Powell said that they might have to raise the rates, but chances are they won't, but the headline is going to read worst case scenario because that's how they grab your attention. This scenario, they're most likely going to be raising the rates 50 basis points because the economy realistically is doing well, so they are safe enough to be able to raise the rates 50 basis points without causing too many other issues that are going on. So this is actually probably a good thing. As far as I'm concerned, raising the rates 50 basis points in the next two meetings is fine. Let's get ourselves back to 2 to 2.5% interest rates as soon as we possibly can to get inflation in line as soon as we can, so we don't have to, have this long drawn out raising of rates and dropping of inflation. Let's get it done as soon as possible. And heck, if we can get it there by the time we hit the end of Q3 versus getting there, in Q2 of 2023, it'll be great. Let's get there, let's get this over with and move on. We are in a safe enough place with the economy right now that we can do this and make it happen to get it over with. And so the reason that the market will sell off on news like this about a 50 basis point hike is because in a rising interest rate environment, we see PE compression happening. So this is why growth stocks usually take the biggest hit because they have the highest PE ratios. Many of them aren't even profitable yet, so their PE ratios are infinite. And when you have an infinite PE ratio, those are the ones that are getting hit the hardest. Those are the ones that you've probably seen in your portfolio if you have them, got destroyed back in January and really have not recovered yet. Because we're not at a point where we're going to be in an environment where they can grow. This is also why when we see Tesla coming down as far as it did after the huge earnings that they had, we're just compressing the PE ratio. That's really all it is. And looking at it, I have a feeling we're probably going to continue to compress over the course of the year. Maybe if we get down to 50, we'll stop there. So I think the two places we may stop with compression are either going to be at a 50 PE for Tesla, or once we see inflation actually coming down significantly, then we'll see the market turning around and the PE ratios can climb back up again with these growth stocks. That's just my take on this. But looking at your portfolio, you can probably see it clearly that all the stocks that have high PE ratios are all getting compressed right down. And so what you want to look for in an environment like this is what stocks have a PE ratio that has been compressed significantly more than they were before, and see where they were trading prior to this. Because Tesla, obviously we know, just became profitable in the last year and a half, but their profits are growing significantly. So you want to make sure that it's a profitable stock, because anything that's not profitable, it doesn't even have a PE ratio, so it's hard to judge. But if you're looking at like the Apples, the Teslas, look at those companies that are profitable, their PE ratio is compressing significantly. And as it comes down, the more it compresses, the better the buying opportunity is going to be. Because once we come out of a rising interest rate environment and growth stocks can flourish again, those stocks are going to spring back up the fastest. So really just picture it as a spring getting compressed all the way down, and as soon as the pressure gets taken off, it's going to shoot right back up again. That's exactly what's happening in these growth stocks. So if you want to get into these stocks, this is why I buy a little bit at a time as we come down, because I'm literally buying as that spring is compressing. And so then, we never know when it's going to be fully compressed. That's why dollar cost averaging is the best way to go. But eventually that spring will stop being compressed. We saw it for, a solid 10 years after the 2009 recession. So that spring was compressed significantly during that recession. And then the spring pressure came off and we saw the best stocks like the Apples, Amazons, Googles, they all exploded after this because of that compression. So again, this is why they say fortunes are born during bear markets. Because in bear markets, that compression is happening significantly, and then you buy at that point and you get a lot more money coming out of it as that spring rebounds. And so the moves I ended up making today is I got stopped out of my Apple. I had it for a long time. I really do like Apple long term, but as I said with Enphase yesterday, I think we're going to have some good buying opportunities to get back in at some point. So I'm not too concerned. I do think we are going to fall down further over the next couple of weeks and potentially over the next month and a half. So I've got now about 13% cash, which is more than I would like, but now I have the ability to be able to jump into some more stocks that I want. I can dollar cost average into some of my other plays that I've got to bring the cost basis down so I can get out of those a little bit sooner with some profits later on our next rebound. And I can also buy into some new positions that I don't have yet in order to really get a great profit out of it. Thinking about stocks like, Affirm or even Enphase prior to this, I said it yesterday, Enphase dropped down to 120 and then shot up to 216. So there's a lot of good stocks that are like that out there where you can buy in low and get a quick profit very quickly. Again, I'm not a swing trader, but this environment and paying attention to it really has a lot of opportunities out there. And so I'm going to try to grab a few of these opportunities if I can, just to make some nice profits. I'm not going to be doing this for long term. This is strictly going to be buying in at lower prices, dollar cost averaging a little bit on the way down, and then as soon as I go profitable, setting in stops to protect myself and my gains to make those profits, because I think we will fall again. And even if we go through a fall all the way through June, and then we rebound through the summer, we'll probably fall again for midterm elections, and I'll be ready at that point with some more profits to buy in again. Plus, freeing up all this cash allows me to invest a little bit more into Tesla like I would like to get myself to 10 shares before we split. So this has been a great opportunity for me to be able to move this way and get those profits and cash freed up to be a lot more agile. We talk a lot on here about being agile investors, and I learned a lot from Q1 and what we went through there, and now I'm ready in Q2 here if this happens again. And now having this cash on hand really gives me the mobility to go in any direction depending on whichever way the market moves. Let me know in the comments below. Did you make any moves today? How do you feel about the 50 basis point hike that we are probably going to get in May? Let me know how you feel about the rates going up again in June. Share your thoughts in the comments. Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all of the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.